Moin moin! Welcome to the Foundation for the Study of Cycles. My name is Lars von Thienen, member of the board, and every week on Monday we meet here and I'm here for you to explain about cycle analysis. I just need to stop it here. So thanks for joining me live. This session is live today. I have been asked a lot of times, not only to cover crypto and the US markets, which we mainly do here in the weekly session. I've also often been asked to cover Asian and different markets. And therefore, today we will have a special look at the Chinese market. So also having a look how the cycle analysis works on the Shanghai Composite. So maybe something a lot of you have been anyhow looking into, not to pay too much attention for the US and European markets. So therefore, today we will stick 20 minutes to the Chinese market and the Chinese composite data, and I will walk you through the history, how cycles worked also, or cycle analysis worked on the Shanghai Composite. We will review daily and weekly data set, and at the end I will show you the current outlook on daily and weekly data for the Chinese Shanghai Composite Index. So, and I will build in some educational topics, which to look out for the cycle composite. So I hope you will like anyhow this look at the Chinese market. And as we are live, for sure I will watch and monitor the chat section. So feel free to drop in your questions and comments at the end of the session. So in 20 minutes from now, I will have a look at your comments and we will review live your questions here. Okay, so let's get into the Chinese markets. I have prepared four sets now. So we will walk through 4 examples with the Shanghai Composite. So the first example, as we see here, which we will review with our cycle analyzer, is ahead of the big up move back. I mean, this is back in 2014. So prior to the main move here in the markets, we want to get a clue if cycles would have given us some kind of clue that we could have expected this larger upswing here. So therefore, as always, I recommend approximately 3 years of daily data, 1000 data points here as we are used. So just aligning our analysis somewhere here before the starting point. We have some swings in the data, so it's not a straight up line. So the cycle analysis has interesting data to look at. So therefore, first, if you're new to cycle analysis and digital signal processing, how we are doing this here on this channel, first we will look out into the spectrum, what is currently shown here on the screen. The spectrum gives us an idea about which cycles are currently active. So we will look for peaks in this spectrum. So the x-axis here shows us the length, so the length of the cycles, and the y-axis is the so-called amplitude of each cycle. And if we can see peaks, so a high amplitude of cycle which has been detected, then we can check at with length this amplitude was seen, and this gives us the information where we can find an active cycle in this data set. Yeah, that's how pure cycle analysis works. So if you are new to this kind of analysis, that's the basic procedure you should always apply. Doesn't matter which market or which time frame you're looking on. This is the same procedure as always. Then there's more complicated stuff, but we are first looking for the peaks in the spectrum. If we do this with this daily data, we can clearly see 3 peaks which are separated by the rest. So that's always what you try to identify. We have 1 peak here, the 2nd peak here, and the 3rd peak here. So you can clearly spot them also using your eye in this data set here. And that's the reason you can pick these 3 cycles now to build a composite. We can browse over the chart here, which gives us a length, so the 77 days, 184 days, and 262 days. You should also check the green triangles, give you an indication about it's the Bartle score, so it's a verification. It's just an additional measurement, and the size of the triangles also is about strength. But I will talk about strength in a minute from now. So if we now activate these cycles in the scanner, so we will now build a composite, which is just adding these 3 cycles on top of each other. So the first was 77 days, the second 184 days, and then 262 days, which is this one here. So I'm now just adding these 3 cycles on top of each other. Then first of all, you should always check in regards to the correlation of the timing information of the composite you have now and the price behavior on the market. It's shown here by a mathematical measure, which is shown here above. It's the historical measure. If it's green, it's above 0.5, which is a high correlation just from a mathematical point of view. But you should also always be aware of the composite which you have built is used for timing. So even though it's plotted as an overlay on the chart, we check for the timing of these, of the turns of the indicator. So what you can see here on the right hand side, so just to explain what I mean by timing, it's not about the absolute amplitude move, it's about the swings here. Yeah, you see here's the low of the composite, the low on the market, and the high on the composite, the high on the market. So here we can align these ones here with the low here. So then here the high, somewhere here the low. So this one, here the top, here the next low, top here. So this is how we align it. Now the absolute amplitude move is out of sync, but this is not what we're looking for. We're just looking for the timing of this composite here. And you can see that even though the amplitude, which is not of our interest, might be out of sync, the timing information is quite on. So yeah, this I will just mark it that you can see it here. So these are the tops and bottoms, what we are looking for, and price is exactly acting against the composite here. So the next swing up, down, and then the large upswing here, which is then correlating to this one here. So even the smaller swings seem to align nicely, but that's just the past. Yeah, just explaining what you're looking for the composite. If you see this kind of composite, it has a very good tracking with the past data, but that's not what we're really interested for. We wanted to check if there is any predictive value in this composite. Keep in mind, we did this at this point in time here. So in the summer of 2015, that's where we did this analysis. And now I just want to explain a little bit. First of all, what you always should look at if you use these kind of composite projection is for the next 1 or 2 important swings which you see at the composite. You should never look too much into the future, or at least at the 5th or 6th turning point, because you anyhow need to update your composite. So the next, or the key movement, yeah, if we see here, is then the next major low is shown here, starting at this point in time here. So you could argue that this swings here might be out of low, but the key takeaway is from this period. I will just mark it below the chart here. So the major low here into the major top into summer. So this is the projection you're looking for, a low forming at this point in time here and a high forming in summer. And that's what exactly happens. So here's the it's a low if you look from the historical perspective, and then this up push here, and then also predicting the exact timing for the expected top. Yeah, it's not just that we have an upswing here even from this point in time here. So this was the upswing. Also then the projected top in the markets within the downswing into this point in time here. Yeah, so to make it a little bit more beautiful, so I say here was the starting point of the major low. So from here into this topping period, and this then the low into this period here. So this is what has been projected by the composite, and this is what you always should keep in mind if you do your composite, even a composite might be, so if we see the sideways market here, or the slight upwards moving market, which has been in sync with the composite anyhow into this point in time here, where we would have expected a kind of top in these markets here. But you see, and I will zoom in now here first, because this is very important learning from this point in time here, that let's make it larger here, that we just focus on, let's say these periods here. So this is the forecasting area. I've just now zoomed into the period where it looks like that the composite was off. So just starting now to, this was the kind of low which was predicted. So the first turning point, which happened then very nicely into this period where we should see a top here. So the first projection worked out into this firm. So confirming an upswing here. And now what happened is by this point in time, somewhere here at this point in time, this upswing has been stopped. And the period we should measure, or we should expect here, is from here to approximately here, because this is where the kind of low is forming. So from a timing perspective, so this range here, and it was a more or less sideways moves. So during this time here, there was no, just a little market action here. So the upswing, which started in, it's not a major upswing anyhow, but the 10% move here, starting in 2014, was then confirmed, or at least this downswing here resulted in a sideways. So the upswing has been stopped. And then the bigger upswing exactly started at this point in time here. So just if you really zoom into this perspective here, I mean, the key was then anyhow, so that we expected from this point in time here, that's what I wanted to mention here, then the upswing into this period, and then the downswing into this period here. But anyhow, I think you get the point here, just from the Chinese point of view. But let's now move forward in time. This is just also to explain how composite forecasting works, on the basic idea. Let's now move fast forward in time. I think we don't want to spend too much time on past market data here, right? Okay, so now I have just prepared already. Let's take a look after this peak here appeared in the Chinese market, what I showed you just afterwards, and then markets dropped and then moved sideways into November 2017 here. So let's use this as a second example. Again, basic procedure here. Let's have a look at the spectrum here. And now I want to highlight another important topic when it comes to the questions which cycles should be picked here, because you see three peaks here in the spectrum, which should make sense to pick one out of these three here. And you might have already recognized that if you are the size of these triangles also plays an important role, and the size of the triangle explains the strength of each cycle, and the strength is also shown on the left-hand side here in the table. So it's just listing the peaks from the spectrum here, and you see on the top of this chart the cycle with a length of 98 has been listed because it has the highest strength score. So even though it might not have been the largest amplitude, if you look, the 130 has a higher amplitude and has a longer length cycle, but in regards to the strength, even the shorter one plays a more important role if it comes to price action. So I would say these two cycles here are very close to each other if you just compare them by length and amplitude. So these two cycles here are very closely related to each other. So which one should you pick? And you should always pick the one with the strongest impact on the price movement, because the strength is just a measurement how much amplitude per day, so price movement per day, is impacted by this cycle. And if you want this for your market forecasting, you always look for the cycle which has the most impact on movement per day. Yeah, so this is then in regards to, in addition to the timing information, the second important information. So just by using this cycle, and before you start to build a composite out of different cycles, you should always cross-check what the so-called dominant cycle shows you. And this is, I would please follow this procedure. The dominant cycle is also listed here in the lower left, but you need to be careful about the settings. So here you see it might look like a deviation about 99 compared to 98 here in the listing. This can be explained by just using different settings here. So the Cycle Explorer it has an embedded dynamic approach, so therefore the length slightly changes here, which means the 99 is related to that. If you want to make them exactly the same, please switch the Explorer to full ensemble range, which just means that it uses here the same amount. But it looks like it has an offset also in the Bartle score, so therefore I said it's always important to keep an eye on the settings here, and it does not show up also because the Bartles limit is set to 49, and the 98 has a Bartles below 50. So we need to lower the setting here to make this exactly the same. And now you see also that the dominant cycle is exactly the same from the full term analysis. But more important is that you understand how to get to the most dominant cycle. To be honest, it would have not been really a difference if you select 99 or 98 here on this chart. So, but I wanted to explain why this one, even though if you pick the other ones, they would look more or less the same. It's more or less a short-term cycle here from the past data. It's really good aligned with major lows and major bottoms here in the data set. So now let's see how the predictive value was out of this cycle here. And as explained always, same procedure here. Oops, sorry. So you can see that the key points have been here. So predicting the top exactly on time here in the market. Here the low was slightly off, but at least we saw from here we had a down projection into this area here. So this top here was then more or less shifted, but then here this was the forming the low period here in the market, and then the upswing into this period, and then the next low. And this is now interesting because we're just talking about the prediction range, this low here from reader price and the cycle. So these two, let's make it even more clearer here. So just looking alone at these two key areas, so this top in the market here and this low in the market here, are really picture perfect in alignment with the predicted time window and the exact point where the top and the low in the market appears. And same to these points here. So there's the predicted one. They are lying on the same point in time here. So you see that these three predicted turning points in regard to timing information have been very informative. So you should always, and I've explained this in previous sessions a lot of times, so I will not repeat this topic here. If you know also from your past analysis which cycles performed in the market, you can clearly allow the deviation, one or two swings, which we see here on the left-hand side as this down move here, but then as the cycle was really of very high predictive value into the future of the three swings I've just shown you. Okay, so that's a little bit about education about how to pick the cycles. And now let's move to today and have a look at the Chinese markets here. Let's do this, as I always try to explain, with daily and with weekly data. So never just look on one time frame alone. So let's start. This should be today, right? It's the 17th January. Yes, this is today. And we have now the daily data of the Shanghai Composite Index. So the Chinese stock market. Let's first start with the daily cycles here. So using the last 3 years, which is the standard procedure, I would also recommend. So the key cycles we got from our spectrum here. So just same procedure as always. James, please, but just kidding. So we have at this point, again, 3 peaks in the spectrum, which are clearly separated in the digital signal processing. This is important. So you see, I'm just following a standard procedure how to pick the cycles here. So these 3, they stand out from a visual point of view. And that's why I also like the visual perspective in the spectrum, that I can clearly spot them by eye. For sure, the mathematical points are just also visible in the table. So the key point here is at least this shorter one here, because a very strong triangle, which means a very high strength, even though it's the smallest cycle from the length, but also a green triangle, so good statistical significance from the Bartle score. Then the second important would be here with this topic here. So this is the cycle with the length of 164, 67 and 100. 11 to pick off. Let me just check. 164. Yeah, and maybe we could also argue that this cycle here could be important. It's not a clear peak in the spectrum, but you see it's a very long-term cycle, and I always also like using or finding the longest cycle if there is one, and there's nothing in between. So there's a very good separation here between this longer cycle and then the next one, which is below 200. So there are not a lot of peaks on the longer time frame. So this could be an argument that we should also pay attention to this cycle here. It's a green triangle. It's a very long cycle with 362 days in the market. So these 3 to 4 cycles could be picked. Therefore, let's start to build a composite here. So the one with the 67, 164, and first then also let's add the longest one first, and then we can fine tune it with different cycles. So I've now picked these cycles here for our composite, and as always, a quick cross check. You see here from the green correlation scores, we have a very good correlation with past market data. So the timing of these cycles have been, just 3 cycles have been able to explain major timing points in the markets, not absolute price movements. But you see, if I'm, let's give you a visual indication, also showing you why so here the top here, the low here, I think that's same procedure following here. I think you can see it. I will just do it very quickly. I'm sure you're following this procedure always here, then the key low, which is here and here. So the key turning points are really in sync with the timing information here, the low, the top. So now again, don't pay attention to the absolute amplitude. Here's the low, which is exactly in alignment with this low here. Then here's the top, which is in alignment with this top here. And then here we have the next low, and here we are today. Let's face it this way. So finally, the historical analysis, we can conclude this is useful to pay attention to this composite. And now we're looking at today's point in time. So this is where we are today in the Shanghai Composite, and that's what you get also here from the market forecast. Last week we did the S&P 500. So what can we conclude here from a timing perspective? I think the key point here is to pay attention to the summer period. I think you see this is the major point in time. Maybe also this could be the topic here, but I think this time span here, we talk about the time span from end of May, beginning of July, so June, yeah, so the period of June, we could expect a major top, so a topping window for the Shanghai Composite should be seen here, and I would, yeah, right. This is then the key period where we can see major lows in the markets here. So maybe for the next 2 months, we see still downward pressure from the cycles, 2 bottoming areas in February and then later in March, and then a clear projection into an expected upswing into the summer, but then expecting a top in summer, and then you see here. The next important turning point comes then into more later the year. So we should or could expect a drop then once the summer top has been in. But that's the roadmap from the daily composite. Let's now also see if the weekly cycles would confirm this kind of analysis. So therefore, let's do a quick view on the weekly Shanghai Composite. Again, this is where we are today. We have the 17th January, so latest data from today. We're now looking at weekly cycles. Same procedure here. The spectrum shows us the weekly cycles, and in this case, I would only pick one cycle here. Oh, let's pick it, which is here, the best one, which stands out of the spectrum with a length of 136 weeks. In this case, not days, weeks. So we could simply, and you also see this is the most dominant cycle here, because it has the highest strength score. The Bartle score is very good, a higher strength score, a clear peak in the spectrum. So in that case, you should also go by one cycle. I would not add more cycles onto a composite if you see this kind of cycles here. And again, I mean, we still need some proof here to see, but from past behavior, just looking into the last, yeah, these are 15 years. If we just see the last 15 years here, you can see from this top to this point here, then here's the top here. It's not a real low, but at least if you connect the key market price action, you can see that the rhythm is still there. So this weekly rhythm is in the markets for the last 15 years. So this cycle is visible. What I said, we just need confirmation as the final. So we are currently in this down move here, which resulted in a sideways move of the price action, where we had this down facing cycle to this point in time here. So what's now interesting, because this downswing of the weekly cycle here caused the from this point in time here paused the upswing, yeah, which was intact since 2019. So this upswing was paused, and now we are coming to the next point, which is more or less now. So this weekly cycle resumes now into the positive phase of this cycle, yeah, which in most cases resulted also in an upswing of the key cycle here. So, and this weekly cycle now projects and continuous upswing into, yeah, even next year. So this could, now we have two cycles which are not in alignment yet. So therefore you can now combine the daily analysis with the weekly analysis. So this is where and let's zoom in a little bit here. This is where the weekly analysis shows us the next key upswing starts here end of February, right? So end of February, the cycle turns into the positive area, lasting then into summer of next year. And now to use the cycles within cycles approach, you know from the daily cycles, they are currently pointing downwards. Also the first one in February and the later one also early April. So, but this is the window which is really important now. So, and that's the key takeaway here. So this window shows you a clear up-facing market from two important, or I think it was three cycles here. We have picked 3 cycles here in the composite. So in this period from April to June, even maybe if you want to add this into the mix here, also into early July, we have positive daily cycles which get in sync with this weekly cycles here, which also have the upswing here. So adding these cycles within cycles approach would come to the conclusion until March we will have a very difficult market because the daily cycles are still pointing downwards. The weekly cycle is also pointing downwards, but now in the bottoming area here and starting to point up. So I think daily cycles and weekly cycles get into sync during February, and then March, April into summer, the weekly and the daily cycles get into sync from a timing perspective into the summer period. I think that's what we're looking for this timing information. Okay, so therefore I hope, even though I've gone through 2014, 2017 to look at the composite and the dominant cycles are still also visible and detectable in the Chinese stock index. And I showed you even today, I mean, we need to revisit this analysis in summer, but at least from a timing perspective, also here we see some clear forecast. Okay, that's it. That was the message for today. We have analyzed the Chinese markets with daily and weekly cycles. So now, if you want to stay with me, I will for sure pay attention to the questions and now get back to the chat section. So let me look. Happy motoring, moin. So moin moin, and even QWERTY, moin moin. So yes, you're welcome. It's a special kind of slang here in northern Germany. You say moin moin, which is similar to good morning, welcome, good day, good evening. You can always say moin moin, but it has nothing to do with cycles. It's just from my home country here. So if I'm live and you get this chat here, so please allow a little bit of personal note here. So moin moin everyone. But anyhow, do you know of a USA housing price index dataset ID that we can access? To be honest, not now. I'm not analyzing the housing price, but I agree with you, as we've seen interesting analysis on the housing market and the price on the housing market in our yearly analysis. I just will write it down and need to look it up by myself for the next weekly session. So I will write down just housing data. I need to check that, but if I find one, I will promise you in the next week I will show this data set and let's analyze it. Emma Thomas, from the session with Bill the Ruby, can you use the app to find and apply 4-year and 10-year natural cycles onto the annual cycle? This is what so what we're doing here is the kind of dynamic cycle analysis. So we check at a current point in time how the cycles behave, and then we use the current phase, the current length, and the current amplitude to project. This is what also Bill calls dynamic cycles in his approach. While another way to do this is what Bill also calls static cycles. So the seasonal cycle, which is a yearly cycle, repeats in a statical manner, or from a statistical point of view, this is analyzed as static cycle. It repeats every year at a certain point in time, the seasonal yearly cycle. And therefore, Bill also looks at these static cycles which repeat every 4 and 10 years. That's just to explain for everyone here what you mean by your questions. We can use the analyzer in that way because but we can look out if there is a 4-year cycle active. Then we should switch to weekly data. So we should use an weekly data set, and then we need to convert 4 years is, I think, how many weeks? 200. I think 4 years should be something about 200 something weeks. And then if you have this kind of longer data set, then you can look out if there is a 4-year cycle, which would equal in the digital signal processing if you find a peak around 200 weeks in the spectrum. So this is where you can check the so-called 4-year cycle in the current data set if you use, that's 15 years of data, for similar to what I did in the Shanghai Composite, in the weekly data, and then convert the year. So a 10-year cycle, you need to look for a much longer peak here, but the 4-year cycle could be detected looking for these 208 weeks, 212 weeks peak in a weekly data series. And then you can see where the 4-year cycle is in the data set. I mean, it's not the static one, but if you have a peak, it's confirmed that the static cycle is there. That's the kind of approach I would use, at least with this application we are using here. Mike, when a 1-year membership times out, do you send a new notice via email? So you can always decide if you want to renew, or even you can cancel auto renewable, so you will not be charged. I think this in the detail, I don't know how the commercial system works, but please reach out to via email to Liz and Bill, which are doing the customer support. I think they can give you a concrete answer on that. But you have options to also not sign in for auto renewable. Jim, can you show how to sync the dominant versus when the other one shows up once more? So yes, I will explain it, because this is a very often asked question, and it might be confusing to you if you have not heard about that. And therefore I will use just the chart with the Shanghai Composite, where we have a similar situation here. So this is a weekly data set for today, which I used on the Shanghai Composite. And now you see two numbers which might irritate you at first. First of all, here we see the length of 133, and here we see with the length of 99 in the dominant cycle area here. And as I have explained here, the dominant cycle is the one with the highest strength score. So therefore it's also on top, or always on top of the list here. So when we don't see the cycle with a length of 99. So this is the question, why is there a difference between these two cycles, why the method should be the same here? That's due to the different settings which might be used in your configuration here. And to bring both to show you the same figures as the procedure is the same, you should open the settings panel, head to the Explorer session, because the Explorer is responsible for what you see here down below. So everything you set up in the Explorer section will impact what will show up here in the dominant cycle section, while if you use the scanner, this will impact what the spectrum and in the active cycles table session will be seen. So there you can configure how the scanner with the spectrum and how the Explorer work. And therefore the Explorer is set to, that's the first reason you might see a deviation, a dynamic in-sample range. You need to set this to full in-sample range to get the same procedure, because the cycle scanner, so the spectrum, always uses the full data set, the in-sample period you have selected, from start to end. This is the full in-sample range. While the Cycle Explorer could also use the dynamic in-sample range, means which, for example, if you have 20 years of daily data set for your cycle scanner, so you use a very long period with the cycle scanner, while for the Explorer, you just want to look at the current data set. You don't want to use 20 years of daily data for detect the current cycle. Then the dominant cycle, or the Cycle Explorer, will just look at the current past. And this is what dynamic in-sample range means. So the dominant Cycle Explorer, when using the method dynamic in-sample range, just looks at the current past. And if you want to ensure that both use the same in-sample period, you need to set it to full in-sample range. That's the first important point, to make them equal. The second point is that there's also a filter score related to the Bartels value, which means if you have low Bartels, or if the limit is not the same as in the scanner. So if you switch to the scanner, you see the Bartels limits here, which is the minimum of 10, because from the scanner, we want to see all peaks and just use the color coding to filter them out. So with red, blue, and green. So therefore the limit is per se low. And the Explorer then automatically filters out values with lower Bartels score. So you need to, and if you exactly set both the same, so in the Explorer, give it also a 10. Now, both cycle detection methods work exactly the same. So these are the two parameters you need to adjust if you want to make sure that the dominant cycle box gives you the same outcome as the cycle scanner in the table. So I will now just press update. And if I've explained everything correctly, now you see that the list here on top with the length of 163 is the same as shown here in the cycle scanner, and we see the exact same results between these two procedures here. So Jim, I hope that this explanation helped you again to understand that. And I agree, you need to understand what the application shows you, but that's why we are here. And I invite you always, please join the live session, as this is the best place to give a lot of explanation back to you. Okay. Jim, this was you. Mike, where can we find dataset IDs? Dataset IDs. So dataset, the easiest way, there are more ways to do this, but the easiest way, I just need to clean up here my chart, is through the dataset ID is entered here in the upper right corner. And you see it's a very strange ID, which I'm using here for the Shanghai Composite Index. And you might question, where do you get this strange ID from? I think, Mike, that's where your question is coming from. And that's quite simple, because we provide a wrapper around Yahoo Finance. So a very easy way for you to, if you want to chart whatever data feed, if you don't know it, head over to Yahoo Finance, just search for the index you're interested in. So for example, the silver markets, silver futures, and then you can use the same ID which Yahoo Finance shows up. You will find this ID just on the Yahoo page here, which is here in the top. So in this case, it's SE equals F, which is the dataset ID, which is just the same as Yahoo Finance, which you can use to chart this data in the cycle analyzer. So here we see Yahoo Finance, we have SE equals F. You can use this in the cycle scanner here on the right hand top. Just enter SE equals F. And now the important topic to keep in mind here in this case is that you need to tell the analyzer that this data is coming from Yahoo Finance. And therefore you add this short code after this ID. Oops, I will just show you again. So JFA, in addition, which gives the scanner the information that we use the same ID as Yahoo Finance is using. And then we just press enter. We just press enter here. And now you see we have silver data in the market. And you can repeat this procedure with any data set you will find on Yahoo Finance. We can pick up the data with the same ID here in the scanner, which should help you to plot almost everything. At least everything which is on Yahoo you can analyze here. Mark, can you explain how the analyzer finds the phase of each cycle? So yes, that's the purpose of digital signal processing. you might be aware of, I've not talked about it, but in addition to detecting the length of each cycle, which is shown here in the spectrum by where the peak is located in the spectrum, there's always the question in regards to at which current phase is this cycle, because that's even more important as the length alone, because we need to know where the last top or low has occurred in the data set. And therefore, that's now the key where digital signal processing comes in, where the Fourier transformation, or at least a special kind of the Fourier transformation, is able to give you the information of the phase. So, Mark, the simple answer is we use the Fourier analysis, which not only gives you the length, which also gives you the phase in addition. So it's not an additional algorithm which we're using. We're using here standard spectral analysis, which always gives the current phase of the data. The important point here is, and not sure if your question is related to that, but the more data you have from an historical point of view in your analysis, let's say you use 20 years of data and you find a cycle with a length, let's say for today, 200 days, then the digital signal processing checks for the kind of the best fit of this cycle for the 20 years of data. So it's a kind of average phase over the whole data set you're using. And that's the point where also the Cycle Explorer I always would recommend, if you want to do projections from today into the future, you should never use an average of the phase of a very long historical data set. So if you want to get a clue on where to expect the next top or low or bottom of the cycle, don't use too much historical data set, because to detect the length of a cycle, or if a cycle is active, you could also use very long data sets to analyze if this is a very active cycle in this market. If you do it for projections into the future, never trust the phase information from digital signal processing, which used a very large amount of data to get the phase. Because the phase, you want to be the phase as exact as possible, because that's important for the timing into the future. So therefore, you need to build a trade-off. So you should have at least the minimum data you should use for your cycle analysis, I would say, is 3 times the cycle length you're interested in. So for example, if you're interested in the 200-day cycle, you should at a minimum use 600 bars for your analysis. Otherwise, you will not get valid data set for the 200-day cycle. But then don't add too much on top of that. So maybe 800 days is okay, 900 days is okay. But if you add more days to this data set, you will just make the phase detection worse, because you can have then additional confirmation that the 200 cycle is there also 5 years ago, 10 years ago, 20 years ago. But to get a clue on the current phase, if you add more than 600, 700 days, it will just have a negative impact on phase detection. I'm sorry if I'm trying explaining this with very long sentences, but I hope you get a key out of that. So in regards to summarize it just quickly, to detect the length of a cycle, you can use a very large amount of data set for your in-sample period. If you want to project into the future, don't use much more than 3 times of the cycle length you're interested in. This gives you the best results for the current phase, and the phase is derived automatically from the algorithm, which is based on Fourier. Mark, I hope at least I tried to give you a clear answer. Mark. Both comments are on the same question. Got it. Okay. Thanks. That's why we are live. Thanks for your confirmation. But good question, because maybe I don't focus so much here if I do this analysis. It's just, which is the standard procedure I'm using. So thanks for your questions. I think this helps also others to get a better understanding on that. So yes, a lot of questions. And today we had a lot of important questions, which I really like. So maybe I will now take just a final one. I have, can you take a look at gold-silver ratio cycle and its relationship to gold and silver individually? If you want, I mean, I will also write down commodities for next time. I think we don't have the time to do it yet. But if you want to look at the gold-silver ratio, you should maybe upload this ratio data set manually upfront, because I think this gold-silver ratio is not provided as a data set we can just pull up. So, for example, I would recommend build your gold-silver ratio in a manual chart, upload this data set, and then we can analyze if there is a cycle in the relation between gold and silver. Cannot be done automatically just with a click, but if you prepare it upfront and then upload, you can analyze that. And then you could analyze for sure gold and silver, which you just can pull up here in the analyzer and see if you find a similar cycle on gold and silver individually. So I like your approach, AF, which sounds interesting. We just need to prepare the gold-silver ratio as input data upfront. But as I like the idea, besides the housing data, I will also write down gold-silver ratio and gold-silver ratio cycles. So I have something to do for next week. So I will pull up housing data. I will pull up gold-silver ratio, so we can also have a look at the commodities next week. Yes, Excel file closing values, exactly. So you can upload CSV data, we can upload. So if someone out of the community wants to prepare that, please feel free to send me an Excel sheet or comma-separated values of the closing values, and I can prepare the ratio for you. Sure. So AF, that would be very welcome if you can send it to me, or just put a link below the video where this data might be, or send it via email to me, and I will then prepare a cycle analysis next week, Monday, same place, same time. So we are here, we are doing weekly cycle analysis. I want to do this live with you. It's education. We don't do market forecast. The standard risk compliance just applies here. We are doing cycle analysis. Trading the markets requires a lot of additional competencies and knowledge on your hand. So we are focusing on education for cycle analysis and timing information. As always, thanks for joining me. Thanks for staying this time here. I think we have now spent a lot of time for today, but that's what I like. I like the interaction. Hope you will have a nice week. Stay safe, and we will see next week. Bye.